Hi, good afternoon, everybody. Thank you all for joining in. So today's topic is very interesting. How do you grow your wealth faster in India? So we look at some India-specific data and we look at what's been happening currently and what the expectation is going forward to the presentation. So why is India's growth story very strong? Okay, perfect. I did get one. Is it a good time to invest in India? Uh, I'm investing in for the past 3 years now in Saudi. Want to know about Neo? Okay, so we'll cover even the Neo details, but let's talk about India. Yes, India does have a very strong macroeconomic outlook. You already know about favorable demographics and how we are youngest population in the world. But one thing is important is that incomes are rising and the way consumption is and the patterns that are there are changing in India over the last 4 5 years. We've seen a lot of disruption happening in terms of consumption. The way we consume is completely changing. And given this fiscal and monetary easing that has come in both by way of tax reforms as well as GST reforms, that is beneficial completely for India, right? Again, India, despite it being the largest, one of the largest nations in the world, still from a capital flow perspective, we are very small compared to other developing nations in terms of market cap across in the entire world as a percentage of the entire world market cap, right? So we have a lot of scope in terms of growth, and definitely yes, it is a good time to invest in India. Probably a couple of years. So let me get into the valuation place. So yes, India's premium is going down. So we are not very highly valued in terms of our history. We are somewhat at average in the emerging market space across the world. So yes, these are phases where you should look to participate in India aggressively based on how market changes and how sentiment changes is what should be coming in. But given how things are today, given what the premium that we're paying currently for the Indian markets, it is a good time for you to start investing in India now. I covered about how favorable demographics are there. If you look at the expectation going forward as well, we are expected to cross $3,000 sort of per capita incomes, and that can happen very fast. So after that is all ramification. We've seen in China when consumption patterns, when per capita incomes cross $3,000, your consumption patterns completely changed. Right, you're spending more on clothes, you're spending more on food, you're spending more on travel, you're doing a lot of other things. What is the difference between Neo and other PMSs? So I will cover that as well. So Neo is completely a multi-asset, flexible strategy, right? The other products in our suite are more equity driven. This is the only product which is multi-asset driven along with Sphere, right? So Sphere is for residents and Neo is for non-resident, right? But the whole idea now for India is that we are seeing very strong macroeconomic growth. So if you look at how, despite the tariffs coming in, we've still had some good amount of exports and imports that have been coming in. We are seeing good amount of growth that is taking place. But if you compare us to other countries, right? If you look at US doesn't seem to have that opportunity for people to invest in because of the fact that valuations are still at the higher range. Okay. If you look at tech stocks, their price to sales, which is again another valuation metric, it is at the record high levels, right? So across other markets, you do not have too much of an opportunity to go and invest in because valuations are on the higher side. But given India's premium, now is a good time for investors to participate in the Indian market space. So even if you're on my source to wealth, you definitely need to participate a lot more. Right? That's the whole idea. Right. Coming to some macro related data points, right? So inflation is easing. We are seeing that inflation is low and manageable. But if you see what's happening in the US and in the Europe space, inflation is out of control and they are battling with very high inflation, right? So they are going into uncharted territory and that is going to be very hard to manage out. India, for example, does not have any sort of issue at all. Your debt to GDP ratio also in India is very well manageable, and the target's about 53-54% going forward, right? Whereas if you look at the US, about 130-140% of GDP. So here, on all fronts, you're getting a very high quality market to go out and invest in. Now, let's look at the largest part of our entire index. Right? This is where the backbone of the economy is, right? We battled very high non-performing assets. back during the 2016, 2017, and 2018 cycle, where if you see the gross NPA ratio has been all-time highs of 11% or so, and now we are going to all-time lows, right? So we've had a very strong wave of cleanup. We've had very strong wave of policy-driven growth that has come in over the last 5 years, and the next phase also is very well poised to capitalize on whatever infrastructure-related growth and second consumption-related growth that is to come up. Maybe not even in 1 year or 2 years, but from a long-term perspective of 7 years plus, which is which is what we prefer to work with on Neo. Uh, Definitely, India's growth story still continues to remain very, very strong. And from a fundamental basis as well, our backbone, which is our banks, are not in a bad shape at all compared to the rest of the world as well. Right, your industrial activity, right, your again there you're seeing very strong signs. So you are seeing signs of recovery taking place in the Indian market, particularly at the corporate level side. You're already seeing corporate balance sheets to be at their best phase. At the same time, cash flow generation also has been healthy. Earnings growth also is somewhere around 9 to 10%. So that is the expectation. But going forward also, as recovery start taking place, you should see 10, 11% sort of earnings growth numbers. Right. So on all fronts today, here we are seeing that both on the macro side and on the micro side, India is a very high quality market and a high quality area for investors outside to look for investing into. Now, we always have this question of whether to look at large, whether to look at mid, whether to look at small. But the trend going that has been happening over the last 10 years is that the larger businesses are getting larger. At the same time, their balance sheets are getting a lot more better. At the same time, they are only the ones who are powering India's infrastructure plus growth oriented stories. So if you look at Nifty 50 and the top 10 businesses in India, right? If you look at Nifty's top 10 market cap versus the total top 10 market cap, it is coming to a low. So here you're able to get the largest businesses in India at very, very fair to cheap sort of valuation. So we will always look at it from a valuation range: fair, cheap, very cheap, fair, expensive, very expensive. So we are at that phase where you're able to get larger businesses with balance sheet strength at fair to cheap valuation. So that is why Neo is completely focused on capturing all of these particular ideas. The precise reasons why a focus on large cap universe could be a hiding place for the virtue is if you look at mid and smalls are completely expensive at this current juncture. Also, mid more than small, small probably the valuations are correcting. Growth also is coming back on the small caps. So more or less, right, we are in that phase that 2026 and 2027, probably a little bit of 2027, can prove to be a recovery phase for the entire market. Maybe not from a fundamental sentiment basis, but from a fundamental basis, definitely we are signs of very strong recovery. Don't know how the war is going to play out, so nothing to talk. There is a slide on the war as well, but we do not know how this war is going to play out. So X of war, all of these data points, even if there is something, we have always proven to be resilient when it comes to taking all these shocks externally as well. So before we were not very much, but this time around we have been very strong in taking up and absorbing all these external shocks that have come in. So this is the slide that I was talking to you about the war as well. So the bounce backs have been very strong. We have gone through phases as well. But if you look at it from a correction standpoint, right, every correction that has taken place has become much more stable after some time. Right. The last bad that we saw, over the last 6 years or so was the Russia-Ukraine conflict. And this time around also we did see, 6-7% sort of drawdowns at the Iran war as well. But more or less, right, stability is what we have been able to see over the last wars across history as well, where we do not see too much of a drawdown compared to other countries, right? So we have been able to absorb these shocks because from the 2010 to 2015 period up until 2025, during that 10-year period, we have gone through significant cleanup of our both macro and our micro level balance sheets. Okay, so let me get into Neo, right? See, the idea for Neo has been very simple. We've always gotten these queries in terms of, is it really a good time to invest right now? Like there was another query that came. Is it a good time to invest right now? How much should I look to invest? Where do I invest now? And we've always had this multi-asset sort of approach during the advisory phases, where we understood that there is an opportunity always, right, in some asset class or the other, and that every time you have a new winner and every time you have a new loser. For example, gold has been a winner now over the past 3 years, but during that phase of 13 up until 15, you saw that gold did not do phenomenally well, right? So there is always a winner across asset classes and across asset categories, and it's not necessary that the winner will continue to remain a winner, right? So that's where Neo starts coming in. We have option to take 100% equity, 100% debt, 100% precious metals, 100% global, 100% cash as well. So it's completely dynamic, it's completely flexible, right? So the idea is not to have a cap, unlike any other mutual fund that's there outside, where they have to have a net equity exposure of 45 or 50% or something like that. But the whole idea is that we can go 0 to 100 in all asset categories, right? Now let's look at the philosophy. The philosophy is very, very simple. One, we have exposure to high conviction themes that contribute to GDP growth. Like during the phase of 2020 up until 2023, start of 2024, we had very high exposure towards infrastructure and public sector banking related themes. Right. But now every portfolio that we build is completely different. Right. We will want to capitalize on all the opportunities that are there today in current market context, looking at the forward growth that we are able to project, right? So at that phase, that was the theme that we were looking to play. And today, the themes are completely different. Right? We will always prefer to invest with market leaders that are operating in favorable industry structures, right? While having margin of safety as the subconscious backdrop, making sure that we do not want to buy expensive, but at the same time, making sure that we're able to participate in growing ideas, right? That who hold a market leadership sort of uh, uh, in their entire category. Right? So dynamic growth is what we're looking to do. Basically, we are able to shift laterally between asset classes across market cycles. So our debt allocation, for example, was very low at the start of the strategy. And today we have a significant debt allocation because we're having that 0 to 100 sort of flexible uh, uh, mandate. Right. Our entire idea is to make sure that we are able to get the best out of a particular asset class, and we wait patiently, staggered in approaches and staggered out approaches. So as and when ideas and asset classes start playing out, we're able to move to the next best asset class that is readily available to us, where margin of safety is very high. At the same time, they are market leaders. All right. So that's the whole idea. Now, no cap on any particular asset class. We have a top-down and a bottom-up approach on all asset classes, plus concentrated across themes with a market leadership bias. Now I'll take you through how we do this top-down and bottom-up sort of research. Now, when we look at a theme, so let's say, for example, we want to do financial services as a theme. Then we look at it from a top-down and then we look at it from a bottom-up opportunity standpoint. Does the top-down make sense? For example, you saw NPA starting to come down. You're seeing they're well capitalized. The government had to capitalize when they were doing when the gross NPAs were very high. So during COVID, we did not have a very bad banking crisis. At the same time, one more round of capitalization, very small, started to take place even at that phase. So we understood that no, from a top-down standpoint, there is an opportunity for us to invest in the banking sector space. Then we start looking at whether we have to take a active or whether we have to take a passive oriented strategy. Now that active strategy will mean that we can take a direct equity sort of exposure into particular banks, or we can take some certain amount of sectoral slash high conviction ETFs. Right. That is a more passive approach in terms of investing. Likewise, for a bottom-up approach, let's say we want to target a particular business, that no, we want to own more of these particular businesses, that will be completely active. Right. There it will be a mix of equity, it will be a mix of high quality debt. So that is what we'll be able to do at the bottom-up opportunity. Now, once we figured out that this is the top-down opportunity for us to invest in, and the active strategy or a passive strategy is what we look to do, then we start building it from a more staggered approach. Right. So this is what we have done before as well. So public sector banks was one phase that we started to buy into and benefit out of. So top down, passive, sectoral is what we figured. And then it took us almost 1.5 years for us to act on that particular conviction, which means we build very strong weights in those particular segments, in those particular ideas, making sure that the risks are very well managed. It takes us some amount of time. So on day one, we would have some portion of the money going in. So that is how we are able to customize each and every single portfolio differently for every investor that we work for. Right. So on that or in that particular phase, if there are opportunities for us to invest in, deployments will be based on that. And as things start to progress, we get to our targeted weights of how we want to play or how we want to invest in a particular segment. So this took us almost 1.5 years where we were continuously buying and we were making sure that these were very high weights in the entire portfolio that we manage. 10%, can be 11%. In some cases, we've seen 12.5 as well. Depends on the margin of safety that they have to offer to us. As a staggered approach in, the same staggered approach out. It takes us 6 to 8 months to build the entire and deploy all the capital that's there in high conviction ideas. At the same time, while we decide that, okay, this is requires a movement out, we take a staggered approach up. Right, that can also take us 3 or 4 months or so, but customization is what we are looking to. This helps us to do a lot of customization. In that sense, every portfolio is particularly unique. Older and newer portfolios will gradually align, and but at the same time, it remains customized because we reach out to you telling you that okay, now is a great time for you to add into your portfolio, and there are certain ideas that the fund management team would like to participate in. So more or less, we will be sticking to that particular universe, and gradually over time, it will align, right? So no worries on that particular fund. The whole idea is to build versatile portfolios that prosper in all markets, right? So for example, high inflation, high interest rates, you have fixed income that outperforms. In this case, fixed income, and in this last 5 years, we're very interesting. We haven't seen them outperform, but usually this is what happens when you have high growth and we have earnings that start to get re-rated. You have equity that outperforms. You get the best of everything, and then multi-asset starts to outperform when you have a dynamic strategy. Right. Whole idea is versatile portfolios for every single market. Okay, so if you look at our drawdown, so what happens when the markets don't do well? So this is the worst that we have seen. So Neo has seen a drawdown of about 10%, but Nifty has seen a drawdown of about 16% during that phase, and the multi-asset index that we are pegged to has seen a drawdown of about 8.4. So we are less volatile than the broader markets, but slightly more volatile than the multi-asset index because here we are taking a little bit of high conviction calls. We are taking a little bit of an aggressive approach, but again, keeping valuations in mind, we don't like to take too much of risk, and we take our time to build positions in high conviction ideas. So what happens when you add that money? You can do SIP, you can do lump sums, you can do all of it, and we accept all of it. And our idea is to make sure that you're able to participate, give you a vehicle in which you're able to participate very confidently, so that we are able to participate in newer and existing opportunities that are there, where we are able to maintain certain targeted weights, at the same time have smaller weights that are going into newer ideas. Right? The whole positioning is based on the financialization and the consumption-oriented stories, plus some market leadership, plus looking at more all-weather, since we are doing multi-asset sort of investing. Now, how have we done compared to the rest of the industry that's there outside? So this is as of 31st Jan. Newer numbers are completely not published now, but at the end, we do have some numbers in terms of how 20th February sort of looking like. Right. So if you look at it from a since inception, which is back in 21, if you see since that number, we have been able to outperform the best in class ICICI multi-asset fund as well as they're outside. At the same time, the index, at the same time, broader 100% equity sort of indexes. Second, if you look at us even from a flexi cap lens, which we feel that yes, they have that leeway to go between large, mid, and small. If you look at that, even at that particular period over the last 3 years, we have been able to do significantly better than them because we are having that sort of multi-asset approach, and we will always have some asset class that is doing very, very well for us, right? And the others will probably be in a consolidation phase where we show high conviction later on as and when things start to evolve for them. Right. So across all fronts, we have been seeing very strong returns, but this is not something that is going to be delivered to you at every single period. The whole idea for us to work with conservative numbers, because we are doing conservative sort of investing. So the expectation that we are setting for Neo is average inflation plus 5 to 7%. Right. That is the return expectation that you're looking for. That is what we want to set for you. And where do we operate? This is meant for those investors who have a risk profile of somewhere between conservative and moderate. It's not completely conservative, but it's not completely moderate as well, because we are taking care of conservative parts of the portfolio at the same time trying to hit a 6 in balls, which is coming to us at a shorter end. Right. So we try to hit a 6 here and there. Right. So that's the whole idea for Neo, and that is what you need to keep in mind. Okay, this is what I was talking to you about more from a as a allocation standpoint. So across the entire portfolio, 87% is currently in equities. Precious metals is some portion of it, very small. We have been cutting down on our precious metal sort of basket. We have cash and we also have debt in the book. But portfolio that we've been able to build over the last 8 months, the debt allocation has been far higher than that of 5%. 5% looks because we're looking at it more from an overall perspective. Right. So if you look at the current numbers as well, I don't think that you should be looking at this. You should be clearly looking only towards this. Right. Uh, what is the terms of investment? 50 lakhs is the minimum for a PMS, which is SEBI-mandated, so nothing less. We have a fixed fee model of 1.5% per annum, which is charged on your average portfolio value on a quarterly basis. Right. We prefer that we work with investors between 5 to 7 years. No mandate, 0 to 100 across all asset classes. Let me take you through the team. I'm part of the strategy team at ithought, part of the entire M2W program, as well as part of Neo and Sphere both. If you look at our fund management roster, they're very strong. You have Rohit and Rajat on the Kriti side. You have Sam and Niranjan sir on Sphere and Neo, who are co-fund managers. You have Sanjay, who's the co-fund manager of TrueBlue. You have Gaurav and Sendil, who are co-fund managers of our FlexiCap mandate. Everything is headed by Shyam Sir himself. He is the CIO and he is the fund manager also for Sphere. And no decision goes to. He is very, very strong in terms of his active involvement in across all the strategies. So here, the investment committee is him, Sam, Niranjan sir. I'm also part of it, and no call goes through without taking his approval. He's the fund manager. The buck stops with him. Thank you all so much for joining in. Have a great weekend ahead.